It's Monday, 12 o'clock Eastern Standard Time, and that means it's time for the Real Estate Show. Now, next week, we are going to be coming at you at a different time at 6 o'clock Eastern for next week. But this week, normal. Glad you're here, because today I'm going to be walking you through how you can invest in real estate safely. Because there's a lot of factors in play with the real estate investment, and we want to make sure you're investing in the right type of deal that's going to get you the end result that you're looking for. Because right now, you look on the news, you're going to see deals that are in trouble. You're going to see deals where people have lost money, because it's true. Like with any investment, just like buying a stock, if somebody bought a Peloton stock and then, a couple of years ago, and then you had a big crash in Peloton, there's risk in any type of investment. But what you want to do is you want to focus on the things that you can control, and then you want to do everything you can with what you can control to minimize your risk in that investment. That's exactly what I'll be walking you through today on this episode. So very first thing, and I'm going to be speaking both from a passive investing standpoint. So if somebody's an LP looking to invest passively in a deal, or if somebody's just acquiring their own property. But the number one thing we want to look for, and I kind of dropped the hint, I was a little premature there, is we want to look for control. And really having a true understanding of what we can control in a real estate deal. Because here's the fact, or here's the truth. We can't control tax rate. We can't control government policy. We can't control the weather. We can't control job forecasts. We can't control, we can't control lockdowns. We can't control any of that stuff. So the difference between an amateur or a fair weather investor and a professional investor is how they control the opportunity. So what are some things that we can control as a professional investor? Well, we can control purchase price, what we pay for the asset. We can control timeline. We can control when we do things, how long it takes us. We control that. We can control staff hiring. We control team, who we bring on the team, or the team you invest in if you're a passive LP, right? You can control rent increases. Now, you can't control the rent or the market for the rent, but you can control, if there's a gap there, you can control how quickly you move property up. The things like that. You can control what renos you do, when you do them, how much reno you do, right? These are all the things that we control. The market you select. You can control the asset class. But nowhere in here do we see interest rates. Nowhere in here do we see cap rates. Nowhere in here do we see government policy like that. We cannot control those things. So as a professional investor, we want to focus on price, how we do the rent increases, the staff, the business plan, the renos. That's what we can focus on. So if we're looking at how to invest in a deal safely, we want to focus on the difference this makes right here. So what does that look like? Number one, we want to focus on markets, because we control where we're looking for deals. So you want to focus on markets where, even though you can't control government policy, where the government policy aligns with where you feel the value is in the market and what you feel will lead to market growth. So to use an example, Kevin O'Leary has just been on a tear recently, just lambasting, California and New York for their government policy. So if Mr. O'Leary was investing in real estate, he would not be putting his dollars in those two states. He would be looking at perhaps like a Florida, Texas, something like that. That's how we control where we're going. Now, government changes over, new policies come into effect. We can't control that, but you want to make sure you're in the area or the arena playing by the rules or the type of sport that you're looking to play. Right. So if you're looking to play box lacrosse, you don't want to end up on a soccer field or a soccer pitch, right? You want to be with the boards with a bunch of padding. Okay. Once we figure that out, now we want to find the right team. So if you're passively investing as an LP, right? So you want to ask yourself, okay, well, who's the team, who's the investment team that I feel comfortable investing with? Do they have the experience? Do they have the track record? Do they have the business plan and the vision? Do they have the same energy, same communication style? You want to focus on that. Now, you can't control, economic collapse. You can't control when the market goes up, when the market goes down, but you can control the people you work with. If it's more on the active side, hey, well, who's running your team? Are you working with an acquisitions person? If so, do they align with what you're doing? Are you working with a property manager? Do they align with what you're doing? You control the people that you put in your solar system. Once you figure that out, now you control the price. So at what price am I going to purchase this property? Now, you can't control the general market. So, if a market average is $300K per door and you're trying to get it for $100K per door, it doesn't make sense. You have to be realistic, but you can control the price you offer at, the terms you put in the offer. And you know what? If you're in a bidding situation, the property's going up too high, you can always walk away. You control when you do that. Once you figure out the price, now you're going to figure out the business plan. So, hey, this is exactly what we're going to do at this property. Here's the proof we see for that in that market. So, hey, property A, B, and C in the surrounding area, they've been able to do this. With these rent increases, we're going to follow the same business plan. You control that. You control the contractors you hire. You control how quickly, how many units you're going to renovate at a certain time, what specific renovations. You control how quickly you adapt if you see the market shifting in a different way and you're going to change your renovation strategy. All of that stuff you control. You control who's leasing out your property for you. Right? You can see if can you train them better, or do you have to bring somebody else in? That's what you control. Okay. So a professional investor, they're going to focus on this and not worry about interest rates or cap rates or government policy, anything like that. You have to be aware, but you can't focus on it. Now, moving away from Robbie, can you mute that a little bit, because I'm just getting I hear myself twice. Okay, cool. All right. So once we figure out control, now we have to start looking at some other things. Number one is going to be debt or leverage. Because I always say debt is an accelerator. So what do I mean by that? Well, when things are going really, really good, debt can be the rocket fuel you'll need to just take your portfolio and investment to the next level. It just compounds and gone. Now, it can also accelerate when things go bad. It can also accelerate the downturn, right? Because when you add debt and then something goes wrong, whatever, it's and so it can really cut you both ways. And that's why people really say debt's a double-edged sword. So how does this relate to making better investment decisions, safer decisions? Well, you have to understand leverage and how that impacts the investment. So in real estate, we want to use debt. So as opposed to Dave Ramsey saying, hey, just pay off everything in full. In real estate, we want to use debt, right? Because it doesn't make sense if we have a solid business plan, if we're doing all the right things, debt can be a powerful tool in our toolbox to earn better returns. Now, there's a point where we start being risky with debt, and now we get ourselves in trouble. So what does that look like? If we have an asset, so let's say we're buying an apartment building, right? If we have an asset and it's producing, let's call it $1 million a year in revenue, and our debt, let me do it this way. I'm going to explain DSCR. Debt service coverage ratio. So what a lender's looking for is the lender's looking for some wiggle room. Okay. They're looking for wiggle room. So in case something happens, you're still able to make your mortgage payment. So the lender's going to be looking for 1.25. So they're going to be looking for in $1 million a year in this example. They're going to be looking for $1.25 million a year, right? Because now you have this $250,000 wiggle room built in, where you can still keep making your mortgage payments. So with debt, if I'm acquiring a property all cash up here, I have no leverage, right? My risk is if the property value goes down, I'm losing equity, I'm losing cash, I'm losing the money I've invested. But the challenge with that is if you're buying a $10 million piece of real estate property, you're sinking $10 million into that property. Now, what you can do with leverage is if perhaps you can go 60, 40. So if the property is worth $1 million, you're going to have $600K in cash that you put in and $400K cash that the bank's going to loan you. Now, for the use and the privilege of using the bank's money, you have to pay the bank interest. And then you're also going to pay some principal most likely along the way. So you have these monthly payments that you're going to pay out every single month, right? For the privilege of using the bank's money. Now, the benefit is if I have this $1 million asset and I have 600K in, now that I can take that $1 million asset to 1.5 million, right? I've just improved my asset value by 1.5. My cash invested is still 600K, right? So now I have an extra 500K in equity that I've built through owning and managing that real property, but I'm not injecting additional cash. So my return, if I compare my return here versus all cash, having put $1 million in instead of 600K, my return is going to be less. Now, in terms of control and safety, what we have to consider is, well, at what point do I stop being safe in my investment? And that answer is going to depend on you. Some people want to use 50% leverage. So that means if it's $1 million property, they're happy putting $500,000 in and having the bank provide another 500K. Some people are happy with the 75, 25. Whereas where I am providing 25% of the cash, so 250K with the $1 million example, and the bank's providing 750K, right? Or some people 80-20. But what happens is once you get to that point, you have to start worrying about your DSCR, your debt service coverage ratio, where the bank wants a 25% buffer built in to make sure if something happens with the rents, if the rents start crashing, if you have vacancy issues, you're still able to maintain your debt service payments and they don't have to take over the property. That's what they're looking for. So for being safe, we just closed on a deal in St. Pete. And, the debt was a lot lower. It was like 60% leverage. We had 40% of the equity in there. That's a lot lower than 80-20 or 75-25. Because there are people out there who say, hey, listen, I'm buying this real estate property. It's going to be great. I'm leveraging up to 95%. I only have 5% of my own money. Now, it sounds great because the returns on paper are going to show up as really, really, really attractive because you have almost no money in the deal. But what happens if something goes wrong, if rents drop, and now it's basically all debt in the deal? That comes with a price tag, and now you have to meet that debt service with those monthly payments. And if the money dries up, you're toast. So you have to be really, really safe and understand how debt works in a deal, how leverage can be positive, and it can be an amplifier. It can amplify the good times, but it can also amplify the bad times. So that's debt. The other thing we have to think about and consider when we're being safe in a real estate investment is we have to understand decision-making and who gets to make those decisions. So I'm going to attack this two different ways. I'm going to attack this on the passive side. So if you're a passive investor, if you're an LP, right? If you're investing your money with another group, so maybe it's CPI, right? Hey, I have $150,000. I'd like to invest in a deal. I trust you guys. You guys have a good track record. Take the money, invest in one of our deals. Perfect. You have to understand how decisions are made in that property and who gets to make decisions. Because if you're passive, you're not going to be able to make any decisions in terms of how that deal is managed. So you want to make sure that you fully understand the business plan, the approach, understand why things are being done the way they are before you invest in the deal. Because once you're invested, you don't have any voting rights in terms of what happens with how those deals are managed, anything like that. So you really want to make sure you understand fully the business plan, how these people make decisions before you invest your money. Okay. So you want to be safe with that, because a lot of people, if they're investing in their first deal, they think, oh yeah, well, I'll be able to make decisions about where my money goes. Well, understand that matrix in terms of how those decisions are reached. On the flip side, if you're active, you want to understand who makes the decisions on the active side. So if there's 3 partners, how are you going to come to an agreement with what happens? What happens if one person is vehemently opposed to taking a course of action 2 other people want to take? What happens there? How is that decision being reached? Because that can have implications. What happens if you're in a very important part of a deal and one person pumps the brakes and says, hey, I'm totally against this. And you've got this deal in limbo. Maybe you're already invested. What are you going to do as a group? You have to understand what's going to happen with those decisions. I know firsthand from past experience, I was in a situation where we had properties and money disappeared. And then, money was being siphoned off to the other person and the rents weren't being paid or mortgages weren't being paid. Really, really messy situation. You have to understand how decisions operate in that case, but also how those people are made to perform. So perhaps there's a forced buyout if so many criteria or if X criteria are met. What happens at that point? So can you force the buyout of a partner who's no longer performing? Yes or no? Perhaps, right? You got to figure this stuff out. Okay. Last but not least, you want to understand what's called the capital stack. Okay. So the capital stack outlines how equity and debt is treated in a real estate investment. Who gets paid first and how do they get paid? So let me draw this out for you. In a typical stack, in a simple stack, we have debt and we have equity. Debt is money borrowed from somebody, from the bank or another lender, and equity is cash invested. Okay. So in the capital stack, we treat it from the bottom to the top. And what does that mean? Well, the person on the bottom gets paid first, and the person at the top is going to get paid last. So with the bank, if we're using leverage like I talked about to buy a piece of property, we're going to pay an interest rate. Now that interest rate is most likely going to be lower than the equity, the return the equity investors are expecting. Why? Because there's less risk with debt. Why? Because they get paid first. The debt has to get paid back before the equity investors get paid back. So the bank's going to give you better terms and less expensive money than an equity investor would. Okay. Now with equity, there's different types of equity, but usually you want to have something called preferred equity down here and common equity up top. Preferred equity is most likely going to be your LPs, your passive investors, and they're going to get paid after the debt. So deal wraps up, mortgages get all paid out, the LPs, the passive investors get paid out, and then at the top here, very last is going to be your person controlling the deal. That's going to be your sponsor or your GP. So as you're investing in a deal, you want to fully understand, well, who gets paid when, why? Because the payout order is here, but also the risk involved in the deal. If we look at risk, the lower down on the totem pole on the capital stack you go, the less risk. The higher up you go, the greatest risk. So the sponsor in this deal is taking the greatest amount of risk because they get paid last. They have the most to lose here in terms of running the deal. Plus, they're shouldering all this liability. So if you're looking at a deal, you have to understand that you have to understand where you fall in that capital stack. And then you also have to understand, well, who gets paid when, what happens if, you know, the deal goes south. You got to figure that stuff out. Okay. So you have to understand how the capital stack operates. So we've talked about what you can control and what you can't control. We've talked about debt as leverage, and we've talked about the capital stack. That's how you invest in deals safely. You don't want to, like, we were just looking at a pitch deck where they were promising astronomical returns that have no hope ever of being realized. Like, this is fairy dust, pie in the sky, just like ridiculous returns. There's no possible way they can make those returns, but they're advertising that in their pitch deck. Now, there's, you know, legal and liability issues that go along with that. But, you know, if somebody were to invest in that deal, they have to understand how the capital stack works, how people make decisions, what happens, like what can they control? Because with that deck, there's a lot of stuff that it's just pie in the sky. The business plan doesn't make sense, but you have to understand the business plan, right? So if you're looking to invest in a deal safely, a safe real estate deal, there's risk in every single investment, right? There's no investment that doesn't come with risk. But if you focus on what you can control, if you focus on using prudent leverage or using it in a prudent way, and you understand the capital stack, that goes a long way in terms of making more educated and better decisions for your investment. All right. So those are the three things to focus on when we're looking at safe real estate investments. Okay. If you hear somebody say, oh, guaranteed returns, we promise you will 100% make these returns, walk away, because you can't do that. That's don't touch it with a 10-foot pole. All right. So next week on Monday, we're going to go live at 6 p.m. We're going to test something new out. So we've always gone live at 12 o'clock Eastern. Next week, we're going to try 6 p.m. Eastern for the deal. Oh, we got a question here, Ravi? Yeah. What's the question?
So this is a question by Dave Gorski.
Okay, do you have the mic or no?
Right.
Yeah, okay, cool.
How can I find a good realtor?
How do you find a good realtor? Like a real estate agent? Oh, okay. Yeah, so good question. So with a real estate agent, and I'm assuming we're talking about to buy an investment property. His name's Dave, right?
No, D-A-G-O-R-S-K-I. So it's
okay.
Dave Gorski.
Okay. Yeah. So with real estate agents, here's the thing. 95% of real estate agents don't understand real estate. They're really good at opening doors and showing you the living room and the kitchen, but they don't understand the business of real estate investment, right? I used to be a real estate agent. Like, I know, and there's only a handful I would trust in terms of dealing with real estate investments, right? Because the majority, great people, you know, they care about their clients. They're really good at showing houses, but they don't understand real estate as a business, as an investment. So what you want to do is you want to, number one, you want to look at content. So generally speaking, if somebody's an investment-focused agent, it doesn't matter if it's an apartment building or a house, duplex, depending on what industrial site, whatever, they're probably going to be producing content that's speaking directly to that audience. And now you're going to, you know, maybe they're speaking at events, maybe they have a podcast, maybe they have a YouTube channel, maybe they're invited as a guest on all these different things. You want to listen to that content and be like, okay, well, does this person understand what they're talking about? Does it make sense? Are they able to articulate complicated ideas? Like real estate investing, there's a lot of moving parts. If you can't, if that person can't talk in a way that makes sense to you, it's probably not a good fit. You're also going to look at track record. You're also going to look at experience level. Hey, does this real estate agent also own investment properties? If they don't, there's a problem, because it's the same thing with events. Like we deal with all this all the time. There's like event planners and stuff. Like I run this big conference, right? There's event planners who know how to make an event look pretty, but they don't understand the business of events, right? You got to run it to understand to truly understand it. So if you're looking for a real estate agent to help you with an investment property, you want to find somebody who's actually investing themselves, right? That maybe they don't have to own $1 billion of real estate, but they have to own some investment properties because they'll have gone through the challenges that you're going to go through too, and they can tell you all the good and bad and everything in between all those stories, right? And then what you want to do, so what the process I follow is you want to find like 10 to 20 agents on your list, check them out. You're going to narrow it down. And you're going to choose 5, the top 5, sit down and talk with them, interview them. They're going to qualify you. They're going to be asking you questions about yourself and what you want to do. You're going to be interviewing them. It goes both ways. Once you do that, there's probably going to be 1 or 2 that really stand out, and you're going to move ahead with those people. So depending on your area, the asset class, you may be asked to sign an exclusive agreement at that point. If you're doing residential, 100% do that. If it's commercial, it's a little bit different of a process. That probably won't come up. But you want to find the very best people who are doing the deals, that are active in the market, but also who understand the business of real estate. That's crucial because, honestly, I've seen over the years, picking the wrong agent can lead to losing a lot of money. Like, it's a really big deal, so you don't want to mess it up. Good question.
Yes, his name was David.
Oh, David? Yeah. Okay, cool. Thanks for the question, David. I hope that helps. Any other questions, Rabbi, or are we good?
We're good.
All right, beautiful. So I hope this was helpful. Next week, again, new time, 6 o'clock Eastern, just for that week. We're going to test something new, and then we'll be back at our normal 12 o'clock Eastern time. Well, actually, that'll be Rabbi's decision depending on how the test goes. So we'll see how it goes. All right, awesome. This was fun. Be safe in terms of your real estate investments. Focus on what you can control. I'll see you next week.